Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello and welcome to LiveSquawk's Market Talk. We are previewing today's ECB interest rate decision with our European editor, Eric Culp, and Gunther, portfolio manager, speaking on his own, under his own steam, basically. So if we get going, we'll get going in a minute. Just to give you a disclaimer on this. So the content provided on this channel is for informational and educational purposes only. I'm not a licensed financial advisor. None of the information shared should be considered as financial investment or trading advice. Please conduct your own research. Consider your financial objectives and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. All right, I've got that bit out of the way. Anyone new to LiveSquawk or who we are, we're an audio news service based in London, Germany, and Montreal now. We have an office over there. And we cover financial market news, anything and everything that makes the markets move. We have an audio player and we alert you in real time to whatever's happening around the world. As you may have noticed, it's been ramping up of late. But today we go back to a more formal structure in terms of what we're likely to see, and that's in the ECB interest rate decision, due up in a couple of hours from now. Just to give you a bit of framework around the meeting today. So the ECB March interest rate decision, we're looking for a 25 basis point cut to take the main rate to 2.75%. We're looking at let's have a look at what Deutsche Bank say here. Deutsche Bank's Mark Wall said he expected the ECB to lower policy rates 25 basis points to 2.5%, making it 150 basis points of cuts in total so far. He says the market will focus on, one, the updated staff macro projections and whether to what extent the trade war and defence spending are captured, two, whether the Governing Council thinks monetary policy is still restrictive, and three, whether the door opens to a short pause or skip in April. All that being said, this was written before we got the the manic period that started last Friday with President Trump and the Ukraine President Zelensky, and then everything that followed thereafter over the weekend and the tariff imposition and everything else. That being said, though, this interest rate cut has been in the works for a while. If you want a more in-depth look at what to expect, our European editor, Eric Culp, has written his preview of today's decision. ECB poised for rate cut amid flagging growth and nascent trade war. Again, analysts expecting then a key rate cut to ease 25 basis points. Economic slowdown raises concerns. Trump renews threats of tariffs on EU goods. Again, officials divide. As of now, we don't, that there's no development on that side on the EU tariffs. Officials divided on restrictiveness of rates, with the decision at 13:15 GMT, that's 14:15 Central European time, and a press conference will follow half an hour later at 13:45 GMT, 14:45 Central European time. So for a more in-depth look, please go to livesquawk.com and search out Eric's piece. He's also up on X and other social media platforms. And with that, I'd like to bring in our two guests, Gunther and Eric. How are you both?
Hello.
Hi there.
Thanks for the invite.
Yeah, good day from Frankfurt, where
Awesome.
It's nice and sunny.
Yeah, it's beautiful here.
And from Zurich, sunny as well.
There we go. It's sunny on this side of the pond, so that's all good. There's a little bit to talk about, I think, today, but I want to focus first and foremost on the interest rate decision itself. Eric, do you want to give us just a bit of background to today's decision and what we're looking for?
Yeah, it's. I think the market is pretty much everybody's betting on a quarter point cut. I think it's a good call. This has been baked in for a while. There's the only really question came up when Isabel Schnabel, a member of the executive board, was asking the question whether or not the current levels are restrictive or not. She suggesting that they are no longer restrictive, which would mean that have they bottomed out already? But people push back immediately. Some of the other members of the governing council are like, nah, they're still restrictive. They still have to go lower. So I mean, they're definitely going lower today. The questions of what's coming ahead. Also, I think people are going to be looking at the growth in inflation estimates from the central bank. But let's face it, the past 3 days have been whiplash inducing when you look at the different headlines coming out of different countries. I mean, what the Germans are doing, talking about how they're going to start spending money, it's like bizarro world now.
Yeah, it's definitely every day brings a new challenge, I think, at the moment for traders and investors alike. But just in terms of the growth forecast, how would you? From your reading, how much are we looking for them to diverge from the last set of forecasts that we've had?
I think it's hard to tell. They may go a little bit lower. If you look at some of the independent analysts, they're knocking it back a couple pegs. One of the most recent, or within the past month, out of Kiel, a German organization, I think they cut their view of Germany down to a minus 0.2% this year for GDP, and that shaved 0.2 of a percentage point off their overall estimate for the Eurozone, which I think is now 0.6%. I mean, that's like nothing. That's almost flatlining. And if you dig in, you'll see that a lot of economists have been ratcheting back their views on Germany and thus the Eurozone over the past 4 or 5 months. Yeah, it's grows slow here. Consumer demand's iffy, but again, things are changing. It's if you like surfing, then just stand on the ground you're on right now, because that's about what it feels like.
Yeah, very good point. And we'll come on to where the changing environment is very shortly. Gunther, do you have anything to add to today's decision itself? Any view really on this? I know you want to share some of your views, so let me just turn you on there. Let me just get that. There we are. Oh, hang on. Let me put you back on. There you go.
Perfect. Yeah,
so, yes,
I think
just
Sure. Eric summed it up quite nicely. And I think all these forecasts we've seen so far, I think you can throw them into the bin. As Eric said, these recent events on the fiscal side, especially in Germany, are very, very significant. And I would like to compare it to the famous quote from Draghi, whatever it takes. And the new German Chancellor, Friedrich Merz, said something similar, and they're all on board. The main parties in Germany are all on board, and that's very important. So it's really a sea change. But just coming back to today's decision. So as Eric said, rate cut is baked in the cake, and not only from economists, but also from stir traders. And further down the road, it's a bit more divided among the economists. The median is 2%. And if you were to put a gun at my head and the stir market is probably expecting another 60 basis points on top of today's cut. To put a gun on my head, I would say the risk is that they don't cut as much. And the main, or maybe not at all, and the main argument is the fiscal side, really.
Sorry, this is are you talking about from April, basically?
Yeah. So further down then. Today 25, and then a bit more than 50 basis points are priced in. Similar to the economists' median here, which we see the yellow bars, the median is also at around 2%. And I think the risk is that they don't cut as much anymore.
Okay.
Yeah, I'd second that. I think the chaos that is about to ensue fiscally is going to put everybody on the back foot. And, if all of a sudden if growth is, going gangbusters, can they really consider cutting rates any further? Because, inflation is close to where they want it. And if they cut and there's a lot of government spending, is it going to go back up again?
I think we need to explain for those listeners who maybe aren't up to speed. When we talk about the fiscal picture now, just to explain, so Germany has had a long, and you guys correct me because you know the Germany economy far better than me in the history, but for time and a day, Germany's been very, very disciplined with its debt levels and doesn't overborrow. It used to have one of the, I guess, the leanest and just most restrictive kind of debt programs we've had out there, because for its size and its GDP per capita and everything else. We saw that change at the start of this week with a change to the German debt brake. Again, Gunther, do you want to just explain very briefly what happened at the start of the week and what it means in the history of what we've seen out of Germany?
Yeah, you're absolutely right. So we're talking about two debt vehicles, basically. We are talking about Sondervermögen, which is a special fund, and it's a budgeting gimmick because to change the debt brake, you need 2/3 of the parliament. And to circumvent that and also push it through rather quickly, they're using the current parliament. As you said, we had the election and the new parliament convenes later in April, I think. But so to push it through now, they created this idea of a Sondervermögen, and it's really sizable amounts. So for defense, I believe it's around 400 billion. And then on top, they also want to invest in the ailing infrastructure, another 400 billion. So really, really decent sums over the next couple of years and further on. And I can only think that other countries now have the green light to also go easy on fiscal. That's what they always wanted. Italy also wants to spend more on defense. France already is a bit precarious with regard to their fiscal situation, but I'm sure they have more leeway now as well. So you see my point, it's massive, massive. And on the opposite side of the Atlantic, I think you can detect some signs of austerity with Doge and so on. So I think there's a nice policy divergence setting up here.
I think you can add a little bit onto that too. The European Commission is also talking about 150 billion in credits for EU militaries, and on top of that, a total of almost 800 billion. Where the money comes from, different issue, right? But if that gets pumped into the economy, this is all what we're talking about right now. It's going to be radically changed our view of how things are going to happen over the next few months and years.
Okay, but obviously this isn't just Germany. I mean, we're looking at the Eurozone as a whole. You'd like to think everyone's going to play their part. Some will, some won't, in terms of the defence fund and everything else. But for Germany, this is just a huge step away, I guess, from where they've been in the past and how they behave as the largest economy in the Eurozone. So this is a bellwether moment, in my opinion, and I think it'll be marked in history on the basis of that. Getting back to today's decision, and we'll come back to the fiscal side of it, and we can look a bit more at that as well. But just in terms of the language that we're going to get today and what to expect, I've got a Bank of America piece here. They say we expect increasing divisions on whether to keep restrictive in the statement. We think that this week is likely too early for that wording to disappear, given what we have heard from different speakers. It may be more of a risk for the April meeting, however. But once it goes, we would not take that as a signal of ECB being done or the ECB being at neutral. It would be a more reflection of internal disagreement on neutral and, more important, on uncertainty about where neutral is. Does that play any part in the narrative at the moment where neutral is, simply because we've got sort of moving feast in terms of everything else? Does that, Gunther, do you think that neutrality at the moment is what they're looking for, or they're just trying to, I don't know, reinforce themselves and gird themselves for what may be to come?
Yeah. So regarding neutrality, let me just share the chart. I mean,
I'll just put that up for you 1 second.
This concept of a neutral rate is very difficult, as we all know. You can't observe it. There are several models, and they all come to different conclusions. So it's more like a trial and error to detect if monetary policy is restrictive or not. But as a rough gauge, I like to look at real interest rates.
Okay.
And here we have in the upper panel the nominal deposit facility rate that's going to be cut to 2.5 today, so the blue line will go lower a bit. That also means that the real policy rate, using current inflation, headline inflation that is, will also go closer to zero. And as an economist, I would say zero is kind of neutral for me. You have periods where it's above zero, when the economy is doing well, and below zero. A good example is, of course, COVID here, the red line, going massively negative. So I would argue we're closer to zero. So what could change now the trajectory of real rates? And I think mainly it is fiscal policy. People say if you increase budget deficits, that should push real rates up. And I think that's gonna happen and is happening if you look at inflation-based indicators here in this chart. So here we have the German 10-year real rate, and that's going higher. So it was on a downward trend for a long, long time. COVID, then it peaked on the downside, and since then we recovered from COVID, and there's a gentle uptrend. And I would assume, or I expect this green line to go much, much higher on the back of fiscal policy.
There's more room in your head. There's far. We may be overdone in the short term at the short end of the curve, but you think there's for the 10-year and out there's more scope.
Yes, and a bit of the opposite happening. That's the black line in the US. Depends how Doge is performing, how the economy is performing. But I'm very skeptical what's happening in the US. I think it's going to backfire with the tariffs, and also this is that they isolate themselves from the Western world and go with the pariah states. You could argue. You see already first signs. They're canceling Starlink, trying to replicate or use now a European version. Talking about not sharing intelligence anymore. You name it. So I think that's a new trend, and that a secular trend that could last for quite a while.
Okay, excellent. Right, just in terms of, I just want to sort of wrap up today's decision itself then. So we're happy to see 25. Yes, we said that. We're less certain about the next decision in April, and we think, if I'm right, tell me if I'm wrong, that we're looking really at a more measured language from Lagarde. With everything that's happening, you should be a bit more measured, a bit more. She'll want to play down everything, and it may be another snooze fest of a press conference, because I think that's where we're going to get the most sort of insight, I guess, into what the ECB is thinking. Again, Bank of America here says it's likely to be the press conference they think is likely to be more interesting. They would not be surprised if we were to learn that there is no unanimity on keeping the restrictive wording. In line with that, while the ECB president is likely to emphasise again that rates are still restrictive, but less so after another cut, we would not be surprised if she were to tell us that while the direction of travel is still clear, there is more uncertainty about the next steps. And while decision on when to stop is likely to be premature, she will probably argue that this is the discussion to have in the not so distant future. So just to again, before we get on to North America and everything else that's happening, do either of you, Eric, do you see a clear messaging coming out of today, or just more fudge based on what we've discussed already?
Yeah, I think there's going to be some obfuscation. The Bank of America's right. They're saying what most analysts are saying right now, that some people within the Governing Council and at the national central bank level see that the bank is really close to neutral. So they don't want a lot more cuts. Others, they're like, yeah, keep cutting. We need growth. We want growth. We want cheap money. So it's easy for her to come out and say, oh, there's unanimity, or, everybody's close to being on the same sheet of music here. But when it comes to, they don't want to broadcast there's internal, infighting. So I think she's probably going to try to focus on the political so she can avoid that. But everybody will ask those questions anyways. This will be the question we asked 3 or 4 times. And fortunately, if you're a journalist and you're asking her questions, very often, if you ask the second or third time, she will confront you and give an answer to it, even though it might not be part of the speaking points for that conference.
Yeah, fair play. Okay. I want to move on now to the US and what we're and Friday's non-farm payroll. Just in terms of what's expected, we're looking for 100. I think it's 160,000 consensus. Gunter, do you have I know you've got some forecast there as well. We'll bring up that on here. Bear with me. So yes, for non-farm payroll, we're looking for February read of 160,000 after 143,000 last month. Private payroll is expected to come in at 146,000, up from 111 previously. The unemployment rate, we're looking for that to stay at 4%, and with the earnings on the earnings front, month over month, 0.3 from 0.5, so that's seen a small fall, but an unchanged year-over-year rate. On the US, clearly this week, we've seen the tariff moves from Trump. Then we've seen, again, it's just gone backwards and forwards, that he's alleviated the tariffs for a month, I think it is. What can we do? I mean, how do you navigate this kind of environment at the moment? Gunter?
Yeah, sure. So just another forecast on the I'm showing here. That's the whisper number. It struck me that it's rather low. So the whisper number is 121, quite a bit below the headline forecast. Yeah, which is quite interesting. My view is that the U.S. economy is in a slowdown. Also because the current government or the president creates a lot of uncertainty. That will mean that if you are now a corporate, maybe you just want to hold off for the time being and see what's going to happen on the tariff front, on the fiscal side. And then you have Doge. And not only will government employment, I think, go down from here. You can see the difference. They're still expecting government employment to grow. That's the difference between the headline and the private payrolls. I think going forward, you will see that this number goes down, government employment. And with these government employees, there's always a link to maybe some contractors, so where they outsource jobs. So there's a multiplier. When you cut government employees, then also private contractors go down, according to Bloomberg. So the multiplier might be just higher, a lot higher. So 300,000, I hear, reduction government employment over the next year. And then on top, maybe times 2. So we're talking some of these numbers. And if growth doesn't pick up and these guys don't find another job somewhere else, you have a bit of a problem. And I think that's gonna happen.
Thank you for bringing growth into it. We saw this week the Atlanta Fed GDP Now real GDP estimate for this year, Q1, and it fell further into contractionary territory at -2. I got down to minus 2.5-ish. I think, I don't know the exact number, but around that level there. It's a bit of a noisy read. So as an index, I'm not sure we can really. It was minus 2.8. Actually, thank you, Eric, for that. Just in terms of the growth outlook for the US, do you see? I'm leaning on to what you said about, or going back to what you said about the jobs and finding another job. We could be in, maybe into year end, into some issues potentially. Would you say, Gunter?
Absolutely. But I think it's not unwarranted. Listening to Bessem, the Treasury Secretary, he wants to get bond yields lower, and part of the equation is also to get those lower is if you reduce demand. So, but of course, the question is then if you slow down growth too much, you're coming to stall speed, and then might talk about a recession at some stage. So it's very difficult to fine tune such a big economy. And I think the tariff thing, short term, will lead to a lot of uncertainty and slow down growth as well. We're seeing that already in the stock market. Yeah. Earnings expectations, for example, are sidelining the last couple of months. They're not rising anymore. So I expect the stock market, if it goes well, to go sideways. If it goes bad, it'd rather go down from here. I wouldn't be surprised.
Well, again, we've seen the sharp moves this week alone. So I wanted to kind of wrap it up now, really. And thank you, for that insight into the US economy and the jobs report. We'll cover that, but we'll bring out a preview for anyone listening. Have a read of what we have to say, and we have a handy little table that gives you all the bank research estimates out there as well. So you'll be seeing that over our social media or on our website in the next couple of days. So just to wrap up then, today's edition, ECB for 25 basis point cut to 2.5%. It will then leave the door open to whether we'll see more action at the April meeting. Growth and or the economic forecast that to be updated today could edge lower a touch from here, but we are now in a wait and see mode in terms of what happens on the fiscal side of things with all the spending we're likely to see and an expected growth impact that will have on the respective economies throughout the Eurozone as well. So thank you to Eric. Thank you, Gunter, for your participation today. Very, very much appreciated, and hopefully people will get some decent insight from it. We'll push this out to all our social media platforms and all the podcast platforms out there as well. You can find us now on Amazon Music, on Spotify, on Apple as well. So you can access us anywhere you need to. But thanks for listening. And yes, good luck in the trading, because I think we're going to need it now with the kind of trading volatility we're seeing at the moment. I don't think it's going to end anytime soon. So enjoy and be careful. Thank you very much and goodbye. Thanks for tuning into the Live Sport podcast. Your edge in the market starts here. Subscribe now.